Most people assume if Congress creates a tax deduction for seniors, it either applies to you or it doesn't. Simple as that. It's not that simple, and that assumption is exactly what's costing people money. There's a new $6,000 deduction on the books for anyone 65 years of age or older. Real money, legal, and yours unless one of three things quietly wipes it out. Because the same income decisions that feel completely routine in retirement, the RMDs, the stock sales, the Roth conversions can quietly wipe out the whole thing before you ever see a dime of it. So, in this video, I'm going to show you what the deduction is, how it stacks, and the three traps that are silently eating it for people that are filing right now. You see, the 2025 Budget Reconciliation Act, the OBBBA, created a brand new tax deduction for taxpayers age 65 and older, $6,000 per eligible person. But before I show you the full picture, there is a picture that most people are completely missing, and I need to explain one thing to you on how this deduction actually works, because it's different from most deductions you've dealt with in the past. This is what's called a below-the-line deduction. That means it doesn't matter whether you take the standard deduction or whether you itemize. Either way, you can claim it on top. It stacks. We'll come back to why that matters in a few minutes, because it changes the math in a way most people aren't running. For now, let me show you what a qualifying couple is actually entitled to. You start with your 2025 standard deduction, which is $31,500 for joint filers. That's your baseline. Then there's the existing senior edition that's been around for a while, and most people have quite honestly forgotten it even exists. That's $1,600 per person, so $3,200 per couple. Add that on. Now, add on the new OBBBA senior deduction, $6,000 per person or $12,000 per couple. Stack all three together, $31,500 plus $3,200 plus $12,000. That's $46,700 in total deductions for a qualifying couple taking just the standard deduction. And that's before any single other write-off. So if you're in the 22% bracket, that's over $10,000 back into your pocket. Now, to get the full $6,000 per person, your MAGI needs to be under $75,000 for a single filer and $150,000 for married filing jointly. Above those levels, the deduction reduces by 6 cents for every dollar over the limit. It fully phases out at $175 for single filers and $250,000 for married filers. But it doesn't disappear instantly, it shrinks, and most people don't realize it's shrinking until after they file. I'll show you exactly what triggers that shrinkage next, because it's probably not what you think. But before that, go ahead and grab the 2026 Retirement Bridge Strategy Bundle down in the description. It's free. It's the exact retirement checklist I use with my private clients, and it flags this deduction and every other trap that surrounds it. Links below. The technical reality is this: the IRS doesn't just look at your pension check or your Social Security to decide if you qualify for this deduction. They look at something called MAGI, or Modified Adjusted Gross Income. Think of MAGI, MAGI, as the IRS's fairness filter, if they can have one. They want to see the income that you have before you took certain perks and write-offs to decide whether you truly qualify for a specific program. MAGI includes a lot of things retirees forget to count. Social Security income, your RMDs, your required minimum distributions, capital gains from selling investments, your Roth conversion income, and all counts towards that number. So you look at your regular income sources and you think, oh, I'm comfortably under $150,000. But then you sold some stock to rebalance your portfolio earlier in the year. Or you took a slightly larger RMD than you needed to, or you did a Roth conversion. Suddenly your MAGI is $165,000 and the deduction is smaller than you expected, and you just didn't see that coming. In my experience, capital gains is the most common blindside for people. Folks sell stocks, sometimes rebalance their portfolio, sometimes it's to help a family member, sometimes it's because the market's been good and they want to lock in their gains. They don't realize that sale just moved the needle on their MAGI. And by the time they find out, the return is filed. Remember, above $150,000 for married couple, the deduction reduces by 6 cents per dollar. You don't fall off a cliff. But for every dollar of unexpected income, it quietly chips away at that $46,700 stack we built. And that's before we get to the second landmine, because the second one doesn't just chip away at this deduction, it adds a whole new layer of costs on top of it. And it shows up 2 years later. Now, most people have never heard of IRMAA until they open their first Medicare bill and wonder why it's higher than their neighbors. IRMAA is the income-related monthly adjusted amount. It's Medicare premium surcharge that kicks in when your income crosses a certain threshold. It's not new. It was created by the Medicare Modernization Act back in 2003, first appeared on your bills in 2007, and it's been quietly running in the background ever since. And quite frankly, most people still don't know it exists. Now, explaining IRMAA can get a little challenging sometimes, but here's what you need to know. The same income event that triggers an MAGI phase-out, the one that chips away at your $46,700 deduction, can simultaneously trigger IRMAA surcharges on your Medicare premiums. Now, the first bracket adds roughly $95 per month per person. For a couple, it's $190 per month. That's $2,280 per year. That's just the entry level. As your income goes higher, the brackets go with you. Now, you're not just losing part of your deduction, you're losing part of your deduction and taking on an additional $2,280 in annual costs from one income decision. But here's the real gut punch, and this is what gets people every time. IRMAA uses a 2-year look back. So the income you report on your 2025 tax return affects your Medicare premiums for 2027. So by the time the bill shows up, the decision that caused it is now 2 years in the past. You can't undo it, which brings me back to my client. He called me all heck bent at the end of the year to do a Roth conversion. I ran the numbers and realized that he had sold stock earlier in the year to help pay for his grandkids' education. Generous move, but it came at a real cost. That sale had already moved up his MAGI. The Roth conversion on top of it would have partially wiped out his $46,700 deduction stack and pushed him into a higher IRMAA bracket, an extra $2,280 a year in Medicare premium starting in 2027. So, from a move he made in good faith trying to help out his grandchild and do the right thing for his retirement, didn't work out. We punted on the conversion. We're now building what I call an income diet for him this year. We're getting his capital gains under control, the unnecessary income under control, so he can do the Roth conversion in the right year, at the right level, and without handing a gift to the IRS. Hey, if this is the kind of information you want to know before it costs you, hit the subscribe button. It helps more people find out before they file. Now, the third landmine, it's different from the other two. It doesn't involve income spiking. It involves a math mistake the new tax law just made a lot easier to make. Here's a 2025 specific problem that didn't exist 2 years ago, and it's catching people in high tax states by surprise. The new law raised the SALT cap, state and local taxes, from $10,000 to $40,000. So if you live in New York, New Jersey, California, Illinois, you know that the $10,000 cap was painful for years. And a lot of people stopped itemizing. When the cap hit, they're able to itemize again, or at least think they can itemize again. Not so fast. Remember what I told you earlier. The $6,000 deduction is a below the line. It stacks on top of whatever route you take, standard or itemized. So the real question isn't to itemize or not. The real question is whether your itemized total is actually higher than the $46,700 standard package. Because if it isn't, you're going to be doing a lot of paperwork for less money. Let me show you what I mean. Take a couple, both over 65, living in a high property tax state. They've paid off most of their home, but they still carry a small mortgage. Here's what their deductions look like. State income and property taxes is $42,000. Now, the SALT limit takes that down to $40,000, so there's cap there. Mortgage interest is $4,000. Charitable gifts are $2,000. Medical expenses are $0. They didn't hit the 7.5 AGI floor, so their itemized deductions are $46,000. Not bad, right? Well, $42,000 state taxes alone under the old law would have been capped at $10,000. Now they're capturing most if not all of the new cap. But the standard deduction package, $31,500 base plus $3,200 existing senior deduction. That's $34,700. You add in another $12,000 for the new senior deduction on top of all that, and you're at $46,700. They're better off taking the standard deduction by $700. Now, either way, you keep the full $12,000 senior deduction, but that $700, nobody catches that one. That's exactly the kind of thing that slips through the cracks when you're on autopilot. The new SALT cap is genuinely good news for people who live in high-tax states. But don't assume it automatically makes itemizing the right call. The math has changed. So run the comparison fresh this year. And if you work with a CPA, which you really should, make sure they're running the comparison for you. If they're not, ask. Politely, but firmly. It's your return and your $700. The checklist in the Retirement Bridge Strategy Bundle walks you through this exactly. Links below in the description. Now, you've got your 3 landmines. Let's talk about what you can actually do about them. I tell my clients all the time, activity is the antidote for anxiety. So let's get specific on this one. The solution to all 3 of these problems is income management. And before you assume this means earn less, it actually doesn't. You're retired. You just can't turn off the income tap. Now, what this means is I'm not asking you not to do something. I'm asking you to do more of something else. There's a big difference there. Because in retirement, you still have real dials to work with. The order you draw from your accounts, when you realize capital gains, whether you spread them across tax years instead of just bunching them, whether you use cash or a qualified charitable distribution from your IRA when you give to charity, and when you do Roth conversions and for how much. These are your levers, and they compound. Pull from the right account in the right year, stay under the MAGI threshold, and you keep the full $46,700 deduction stack and avoid the IRMAA surcharge. Same money, different sequence, completely different tax income. Back to my client. We're not saying he can never do a Roth conversion. We're saying to do it in the right year, at the right income level, so you're not accidentally chipping away at the deduction and triggering the Medicare surcharges at the same time. That's the battle plan we're building for him now. Because when you're working, you have a lot of dials to turn. Most of those are gone now. The ones you have left. When to take your gains, which account to pull from first, when you convert. These are the moves that separate a good retirement from a great one. Hey, the $46,700 deduction is one of the last great gifts the tax code gives you at this stage. It's worth protecting. Okay, you know what the deduction is. You know what wipes it out, and you know what to do about it. That's more than most people know that are filing right now. But knowing the rules and applying to your specific picture, your RMDs, your capital gains, your Social Security, your conversion plans, that's a different problem. Hey, your tax preparer has this year's filing. That's their lane. It's a good one. Let them do their job. But if you want to make sure 2026 doesn't have the same surprises, that conversion timing is right, the gains are managed, that the full $46,700 stack is protected before anything happens to it, that's a different conversation. It's not a conversation to have in March. My calendar is to open up in late April, once taxes are filed. So once you've filed, once the dust has had a chance to settle, that's when we can actually plan ahead instead of scrambling. Links below in the description. So go ahead, grab the 2026 Retirement Bridge Strategy Bundle in that description. It's free. It's the exact same framework. It finds the gaps before we even sit down. So let's wrap this up and put a bow on it. Folks, file smart, protects what's yours. I'm Tim Gardner, and I'll see you in the next video.